The Federal Reserve has cut rates 6 times since September 2024. $6 trillion is sitting in money market accounts right now, earning less every quarter with nowhere obvious to go. And the US Treasury has to refinance $9 trillion of maturing debt in the next 18 months. Not might, has to. And if you are not positioned around that single mechanical fact, you are going to watch the most predictable wealth transfer of the last 20 years happen from the wrong seat. This video is not about what to buy. It is about understanding a system that is currently running a forced repositioning automatically, structurally, with no drama, no headlines, no crypto to blame. And the people who see the mechanics early are going to compound quietly, while everyone else is refreshing their brokerage apps, wondering why their old strategy stopped working. Here is what I am going to walk through today. The 4 forces converging between now and mid-2027. Why each one looks like an opportunity, but hides a trap inside it. And the exact positioning logic I am using with my own money, not theory, not back tests, not trust me bro, current, live, skin in the game. I have been running my own business for over 10 years, surrounded by accountants and fiscal lawyers who taught me one thing early. Money does not disappear, it moves. And right now, it is moving in ways that are extremely predictable if you understand where to look. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use average return assumptions that completely ignore sequence of returns risk and fee drag. Mine uses BlackRock and Vanguard methodology to expose the actual weak points in your plan. And I only ask for your email to send the report, so I do not store any of your financial data. Link is in the description. Now, let me give you the idea that frames everything else in this video. Think about water behind a dam. For 12 years, from 2008 to 2021, the Federal Reserve held interest rates at near zero. That dam was built tall. Water, meaning money, seeking yield, had nowhere useful to go. So it flooded everywhere. Stocks at 60 times earnings, SPACs, NFTs, a JPEG of a monkey selling for $170,000. That is not stupidity, that is physics. When you lower the dam, water spreads across everything. Then the Fed raised rates faster than any time since the 80s. The dam went back up hard. Money flowed toward yield, money markets, short-term treasuries, CDs, places that were actually paying you something again. $6+ trillion parked in money market funds by the end of 2024. The highest concentration of cash on the sidelines in modern financial history. Now the Fed is cutting again, slowly, mechanically, 1/4 point at a time. That dam is being lowered. Water finds its level. Every time I use that phrase in this video, I want you to picture that $6 trillion sitting in money market accounts all over the country, earning a little less every single quarter, slowly, inevitably looking for somewhere else to go. Because here is where it gets interesting. And I do mean interesting, not scary, not exciting, genuinely, mechanically fascinating if you look at it with cold eyes. In a few minutes, I am going to show you exactly where that water is going to flow and what assets reprice when it arrives. But first, I need to show you why the situation is even more structurally broken than the headline number suggests. Because $6 trillion moving is one problem. The other problem is time. Specifically, a maturity wall that the US Treasury and the corporate bond market cannot escape regardless of what the Fed decides to do next. This was baked in years ago, and almost nobody outside of bond desks is talking about it. Let me start with the money market situation. There is a retired school principal in Phoenix named Carol. She does not show up in financial media. She has $400,000 she saved over 35 years, sitting in a money market fund. At the peak in 2023, she was earning 5%. That felt good. That felt like it solved her income problem in retirement without touching a dollar of principal. Then the Fed started cutting. She is now earning around 3.8%. If cuts continue on their current trajectory through 2026, she may be looking at 2.5% or lower within 18 months. That is a $10,000 per year income drop on her $400,000 account without spending a single dollar, without making a single mistake. Carol is not one person. Carol is millions of people. Aggregate that math across $6 trillion in money market funds. A single percentage point drop in yield is $60 billion per year that stops flowing to savers. And that money does not sit there accepting zero and shrugging. It moves. That is the physics. Water finds its level. Here is what historically moves when money market yield drops. I am not guessing. I am looking at 4 separate Fed cutting cycles since the 90s. Money flows first into short duration bonds, then dividend stocks, then longer duration bonds, and finally, if the cycle runs long enough, back into real estate. Not all at once, in sequence. Like water filling a series of containers from left to right, the playbook exists. It has been run 4 times. And 4 out of 4 times, the people who positioned slightly ahead of the flow made significantly more than the people who waited for confirmation. Pattern interrupt. The last time this dynamic played out cleanly in 2019, when the Fed cut 3 times the S&P 500, returned 31.5% in a single calendar year. Nobody was writing that on the wall in January 2019. Most analysts were calling for a slowdown. I am not predicting 30% returns. I am pointing out that the mechanics favor movement. The question is movement into what? But here is what nobody is telling you about the money market trade. The obvious move, rates are dropping, so buy bonds, has a trap inside it. The trap is duration risk. When you buy a 30-year bond, you are locking your money into today's rate for 3 decades. If inflation reaccelerates, and given the structural deficits the US government is running, that is not a fringe scenario. You are sitting on a bond that loses real value for 30 years. The people who bought 30-year treasuries in 2020, expecting rates to stay low forever, watched their bond portfolios fall over 30% in 2022. 30%. On the asset class that was supposed to be safe, that is not a catastrophe story. That is a physics lesson. Duration risk cuts both ways. So the obvious move is not the right move. The right move requires understanding what is actually happening underneath the rate cycle. Which brings me to the thing almost nobody outside of fixed income desks is looking at. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. I know that sounds like a throwaway line. Algorithmically, it is not. The US Treasury has to refinance approximately $9 trillion in maturing debt between now and the end of 2026. $9 trillion. Let me make that number real. The entire annual GDP of the United States is roughly $29 trillion. The Treasury is rolling over, meaning paying off and reissuing an amount equivalent to about 30% of the entire economy's annual output in 18 months. This is not optional. This is not a policy choice. This is debt that was issued during the post-pandemic period when the Treasury got addicted to bills and short-term notes because they were cheaper, and it is coming due. And it has to be paid back by issuing new debt at whatever rate the market demands at that moment. Here's the subtle game inside this that almost nobody explains clearly. When the Treasury issues new debt, it competes for buyers. The more debt it issues, the higher the yield it has to offer to attract those buyers. Higher yields on treasuries mean higher yields across the entire bond market because every other bond in America prices itself relative to the risk-free treasury rate. Higher yields across the bond market mean lower prices for stocks because the discount rate on future earnings goes up. In other words, the Treasury's refinancing need creates structural upward pressure on rates even as the Fed is trying to cut them. The Fed controls the short end of the yield curve, the market controls the long end. Right now, those two forces are pointing in opposite directions. Bond traders call this a bear steepener. The short end drops as the Fed cuts. The long end stays elevated or moves higher because of supply pressure from Treasury issuance. The curve gets steep. And a steep curve has historically been one of the most reliable signals of a major economic regime change. The last 3 times the yield curve steepened sharply, 1990, 2001, 2008 recessions, followed within 12 to 18 months. The 4th time, in 2019, it did not. The economy muddled through until an exogenous shock did it instead. It is a pattern, not a law. But I find it genuinely interesting, not alarming, just interesting that we are watching the setup again in 2026. Now here is where I want to introduce someone else into this story. Someone who will come back later, and someone whose situation is going to matter a lot by the time we get to the end. There is a guy named Marcus. He is 44 years old. He makes about $150,000 a year, maxes his 401k every year, has been in a target date 2045 fund for 15 years. By every conventional measure, Marcus is doing everything right. He is the exact person the financial advice industry built its entire product suite for. And Marcus is about to get a very expensive education in the difference between doing the right thing and understanding what you are doing. I will come back to him because his story resolves in a way that changes how you think about the whole system. Stay with me because this next part changes everything. Let us talk about corporate debt. Because while everyone has been focused on the Federal Reserve and government bonds, corporate America quietly built its own maturity wall. And this is the subplot inside the main story that most people are completely missing. During the low rate era, roughly 2012 through 2021 companies borrowed at 2%, 2.5%, 3%. They issued 10-year bonds. They bought back stock, paid dividends, made acquisitions. Everything made rational sense when money was effectively free. Those 10-year bonds are maturing right now. And corporate America has to roll them over at 5%, 6%, sometimes higher depending on credit quality. Here's a story that makes this concrete. There is a regional grocery chain in the Midwest, 47 stores, family owned for 3 generations. In 2015, they borrowed $40 million at 3.2% to upgrade their supply chain and open 8 new locations. Annual interest cost, $1.28 million. Manageable, profitable, reasonable bet on the future. That loan matured in 2025. They refinanced at 6.1%. Annual interest cost, $2.44 million. Almost exactly double. Nothing changed about their business. Same stores, same customers, same produce margins, but they are now paying $1.16 million more per year to stand in exactly the same spot. Multiply that by every mid-sized business in America that did the same thing between 2012 and 2021. The Bank for International Settlements estimated in 2024 that roughly $2 trillion in US corporate debt was scheduled to mature by 2027 at significantly higher refinancing rates than the original issuance. That is a structural profitability squeeze. Not a crash, not a crisis headline, a slow, quiet squeeze. And what happens when profit margins get compressed across a wide swath of corporate America? Hiring slows, share buybacks slow, dividends come under pressure, and earnings multiples, which are already historically expensive by most valuation measures, face a headwind that has nothing to do with economic growth and everything to do with the mechanical cost of borrowed money. Now, you are asking yourself, is this bearish? Should I sell everything and go to cash? No. And here's why that reaction is exactly the trap. You think the problem is the macro environment. Actually, the problem is your own response to it. The 3 levels of response to what I am describing look like this. Level 1 is the person who hears structural headwinds and panic sells everything, moves to cash, waits for the bottom that may or may not come on the schedule they imagined, misses 40% of a subsequent rally, and gets back in at exactly the wrong time. I've watched this play out so many times, it is almost comforting in its consistency. These are not unintelligent people. They are intelligent people running a broken mental model under emotional pressure. Level 2 is the person who hears money markets are losing yield and immediately buys 30-year bonds or jumps into rate-sensitive real estate investment trusts at the first sign of a Fed cut, without understanding duration risk, without accounting for what Treasury supply pressure does to the long end of the curve. This person is making the right call at the wrong level of the system. They are solving a 4-piece puzzle with 2 pieces. Level 3 is the person who understands that these forces are mechanical. They resolve over time. And the real advantage comes from being in the right assets at the right point in the repricing sequence. Not from predicting the macro, but from following the flow. Water finds its level. You do not predict where it goes. You look at the terrain and follow the physics. Now let me tell you what the terrain actually looks like right now. Short duration bonds, specifically 2 to 5 year treasuries and investment grade corporate bonds, sit in a sweet spot. They benefit from rate cuts at the short end without carrying the duration exposure of the long end. Nobody is going on financial Twitter to brag about their 2-year treasury position. But I own them, and I am comfortable owning them because they make mechanical sense given the supply dynamics at the long end. Dividend-focused equities, specifically companies with strong free cash flow, low debt-to-equity ratios, and a history of growing their dividend over time, tend to attract money flowing out of money market funds when yields drop. Not because of some sophisticated analytical insight, but because investors have a deeply human tendency to look for yield substitutes when their current source disappoints. It is behavioral, it is predictable, and it tends to set up price appreciation in those names well before the fundamentals visibly improve. International developed market equities, specifically Europe and Japan, have been chronically undervalued relative to US equities for several years now. A weaker dollar environment, which historically accompanies a Fed cutting cycle, boosts returns for US investors holding foreign-denominated assets. This is not a bold contrarian call. It is on the factor return sheets at Vanguard and BlackRock. It is boring enough that most retail investors ignore it, which, of course, is exactly why it tends to work. But now you might think, okay, this all sounds rational, but it sounds like traditional asset allocation dressed up with a macro story. Where's the actual edge? The edge is timing and sequence. Vanguard published research showing that the majority of long-term investor underperformance relative to the benchmark index came not from selecting bad securities, but from buying and selling at the wrong points in the cycle, buying after confirmation of a rally, selling into weakness. The average investor underperformed the average fund by roughly 1.5% per year over 30-year periods. Not because the funds were badly constructed, because the humans managing the accounts were bad at the human part of it. 1.5% sounds small. On a $200,000 portfolio over 30 years, the difference between 7% average annual returns and 5.5% average annual returns is approximately $530,000. $530,000 lost. Not to market crashes, not to bad companies, not to fraud, to the timing of your own emotions, to the psychological structure of how human beings respond to uncertainty. This is what I keep coming back to. Not because I like being cynical about human behavior, I do, but that is beside the point, but because it is where almost all of the real, durable financial losses happen. Not in the market, in the mirror. Here is a comedic aside that I genuinely cannot stop thinking about. The financial services industry spent 40 years designing products to protect you from the stock market. Turns out the main thing you needed protection from was yourself. Their solution was to charge you 1.25% per year for that service. Elegant, really. The problem and the fee are perfectly aligned. Now let me go to the longest running, most structurally significant financial story in American history. And it is about to hit its most intense phase in the exact same 18-month window we have been talking about, the Great Wealth Transfer. Cerulli Associates, a financial research firm, estimated that approximately $84 trillion will transfer from the baby boomer generation to their heirs over the next 20 years. $84 trillion. That is more than the entire US national debt combined with the annual GDP of China. It started quietly a few years ago. The peak transfer velocity is projected around 2027 through 2032, as the boomer population moves through its mid-70s and 80s. This is not a maybe. Demographics run at exactly 1 year per year, and the conveyor belt is moving. But here is the part that is genuinely interesting about the wealth transfer, and this is where it connects directly to asset prices over the next 18 months. The behavioral profile of The person receiving a large inheritance is completely different from the behavioral profile of the person who built the wealth. The boomer who built a $400,000 portfolio did it over 30 years of dollar cost averaging, ignoring crashes, reinvesting dividends, staying the course through 2001 and 2008. They have a deeply conditioned relationship with their money. They know exactly what it cost them emotionally. The millennial who inherits that same $400,000 has no emotional history with it. It did not arrive through pain. Research from the Williams Group, a legacy planning consultancy, found that roughly 70% of inherited wealth is gone by the end of the second generation. 70%. That is not a moral judgment. That is behavioral economics operating exactly as predicted. Money without context moves differently than money with context. And what does that mean for asset markets between now and 2027? It means that trillions of dollars are about to be under the management of people who statistically hold more cash, trade more actively, allocate to different asset classes than their parents, and have higher tolerance for alternative assets, including private equity, real estate syndicates, and yes, digital assets in their more institutionally credible forms. The shape of asset demand is changing, not because a trend piece said so, because a generation is passing and the water is finding a new level. Now, back to Marcus. Remember him? 44, maxing his 401k target date 2045 fund. Let me give you his actual numbers. His 401k has $320,000 in it. His target date fund automatically holds roughly 75% equities and 25% bonds right now, shifting toward 50-50 by 2035. Standard glide path. Sounds reasonable. The equity portion, $240,000, is in a broad US index. Sensible. The bond portion, $80,000, is in an aggregate bond index, which holds approximately 40% in long duration government bonds. Here is the problem. That 40% long duration bond exposure, about $32,000 of Marcus's money, sits directly in the zone of maximum duration sensitivity during a period of Treasury supply pressure. If the long end of the yield curve rises by 1%, a 10-year bond loses roughly 8 to 9% of its value. If it rises by 2%, not a dramatic scenario given the supply dynamics I described. Marcus's bond allocation loses 16 to 18%. On $32,000, that is a loss of $5,000 to $6,000. Not catastrophic, but it is happening in the part of his portfolio specifically designed to be conservative and safe. Marcus has no idea, because target date funds are designed to be invisible. Set it, forget it. The entire value proposition is not having to think about this. Here is the second layer of Marcus's problem. His 401k plan offers 17 funds. His target date fund charges 0.15% in annual fees. That is actually good. That is Vanguard tier pricing. But the funds his colleagues tend to drift toward the ones with names like Growth Opportunity Fund and Strategic Value Portfolio, charge between 0.8 and 1.2% on. Marcus's $320,000 balance, the difference between 0.15% and 1% in annual fees, compounded over 30 years at 7% gross returns, is approximately $520,000. $520,000. Not paid as a bill, not taken as a lump sum. Silently consumed from compounding returns across 3 decades, while Marcus gets quarterly statements with performance numbers that look perfectly reasonable. Here is a comedic aside I cannot get past. If someone approached Marcus on the street and said, "I need $520,000 from you over the next 30 years, Marcus would have that man arrested. But if a fund company takes that same amount via an annual expense ratio, Marcus nods, signs the enrollment form, and puts the confirmation email in a folder he never opens again. We are, as a species, genuinely remarkable. Now, the final piece, and this is the one I see most people framing incorrectly, even people who follow this stuff closely. Artificial intelligence and what it actually means for your portfolio over the next 18 months. Not the hype, not the fear, the mechanics. Here is what is real. AI is genuinely improving productivity in specific sectors. Software development, customer service operations, logistics, routing, legal research, financial analysis. These gains are measurable and showing up in earnings reports at the companies deploying AI at scale. But the gains are concentrated. The companies capturing the most AI-driven productivity upside are overwhelmingly the same. Companies that already dominate the major indices. The top 7 or 8 companies in the S&P 500 already represent roughly 35% of the entire index by market capitalization. And they are the ones with the engineering talent, the proprietary data infrastructure, and the existing enterprise customer relationships to actually deploy AI at real scale. Everyone else is buying subscriptions and calling it a transformation. What does that mean for the average index investor? It means that holding a broad US index fund is now, more than at any point in the last 30 years, a de facto concentration bet on a handful of mega cap technology companies, which is fine until those companies face serious regulatory pressure, antitrust action, or simply hit a valuation ceiling where the AI premium is already fully priced into the stock. And this is the reversal that nobody is stating clearly. You think the risk over the next 18 months is a recession, or a rate spike, or a geopolitical shock? Actually, the specific underappreciated risk, the one we're thinking about carefully, is that everything goes roughly fine. The economy muddles through, employment stays decent, inflation stays contained, and the stock market treads water for 2 to 3 years because AI earnings growth comes in at solid instead of exceptional, and the market was priced for exceptional. Flat markets are boring to talk about and brutal to live through when you are counting on compounding. A market that goes nowhere for 2 years means your money sat idle for 2 years. You cannot get that time back. Time is the one non-renewable resource in a compounding equation. Every year your capital is not working optimally is a year of growth you permanently forfeit. The grocery chain in the Midwest does not get its interest. Payments refunded when rates eventually drop. Marcus does not get his fee expense back when his fund's performance finally lags. And you do not get your 2 idle compounding years back when the bull market eventually resumes. Let us pull this together, because I do not like delivering a list of problems and walking away. 3 specific moves calibrated to exactly what I have described, not generic advice, not diversify your portfolio. Things that are specific to the structural forces operating in 2026 and 2027. First, if you have cash or money market equivalent assets earning above 4% right now, do not rush to move it, but set a yield threshold. When your money market fund drops below 3.5%, that is your mechanical signal that the flow is beginning. Have your destination asset identified before the rate drops, not after. The crowd moves on, confirmation. You want to move on the signal. Second, look at your bond allocation and understand your average duration. Not whether you own bonds, whether the average duration in your bond fund is above or below 7 years. If it is above 7 years, you are carrying meaningful sensitivity to the long end of the yield curve in an environment where Treasury supply is structurally pressuring that end upward. Shorter duration is not a lesser bond position. In this environment, it is the more considered one. Third, check your 401k expense ratios. Today, not because it is exciting, it is not, but because this is the highest return per minute of effort of any financial action you can take right now. If you are in any fund charging more than 0.5% for broad US equity exposure, there's a cheaper equivalent available in nearly every major plan. The move takes 20 minutes. The effect compounds for 30 years. There's almost no investment decision with a better effort to outcome ratio. Back to Marcus one final time. Marcus, after watching a video like this, maybe this one, maybe a Vanguard white paper, his accountant forwards him. Maybe a conversation at lunch makes one change. He logs into his plan, looks at the fund menu, and finds a short duration bond index fund charging 0.08% that he had never noticed. He moves half his bond allocation into it, keeping some aggregate bond exposure, but reducing his long duration concentration. That single decision, depending on how the long end of the yield curve behaves over the next 3 years, could protect him from somewhere between $8,000 and $25,000 in principal erosion on his bond position. Not a home run, A single hit without drama in 22 minutes, including the time it takes to find his login password. This is the quiet truth of how wealth actually builds over time. The home runs are mostly luck. The singles are mostly choices. Repeated choices, made without emotion, calibrated to mechanics rather than headlines. Water finds its level. It does not hurry. It does not panic. It does not try to be clever. It follows the terrain and ends up exactly where physics says it will. The money in money markets is finding its level right now. The treasury debt is finding its level. The corporate refinancing is finding its level. The wealth transfer is slowly and inexorably finding its level. You do not need to predict any of this. You need to understand the terrain and stop fighting the physics. There are people right now who will read this window correctly, not because they are smarter, not because they have better information than you, but because they did the boring work of understanding how the system actually functions. They looked at the Treasury issuance calendar. They ran the duration math on their bond fund. They checked the expense ratios on their 401k. They positioned ahead of the flow instead of chasing confirmation. And in 5 years, when they look at their account balance, they will not be able to point to a single dramatic moment when everything changed. It will have been a series of quiet, mechanically correct adjustments made while everyone else was watching the news cycle. Lazy investing built more fortune than crypto memes. And if you do not believe that yet, check back in 2027. I will be here, reading the boring documents so you do not have to.